PowerPoint again. Okay, somewhere. Oh, I'm sorry. There. And we'll start with those of you that went through the lecture, it just doesn't hurt to go over and cement some ideas again. Do you want all the lights on, or do you want me to turn some off? Are you okay? Everyone okay? Half the lights off, half on, what?
If we can shut down the front lights. Yeah,
let's try it. See how it works. Oh, that's good.
That?
Yep, that'll work.
Good. When we're going through problems, and if you want the lights on, that's fine. Okay, so this was, for the most part, an overview of principles. We started with understanding what an accounting system is. So the process of an accounting system is to record, organize, summarize, and report, communicate this information to users, as well as to the company's managers. Now, the managers use it for making operating, investment, and financing decisions. External users may use it for providing credit to the company or investing in the company, among other things. There would be like regulatory agencies that use their financial information to assess them based on taxes, or whoever they're linked with that they have to, that are under their jurisdiction. The basic component of an accounting system include, you're going to see this over and over again. Hopefully by the time you hit advanced, you're not going to hear the accounting equation as much, but it's still the integral part of accounting. The accounting equation, what is it? It's assets equal liabilities plus owner's equity. And we create the transactions from information we call source documents. Now, the source documents are basically where the transactions are stored. So a source document may be the purchase of a truck, or the financing of a loan, checks to pay things, bills from vendors, invoices that we have given to clients. Those are all source documents, shipping slips to show that we've received the goods, that we use to create our transactions that ultimately play out in the form of financial statements, which is how we communicate to users. So we take all these records and we store all this accounting information in a system of accounts. The accounts house the various information. And then from there, after we post those transactions, create a trial balance, prepare some adjusting transactions, we end up with financial statements that we issue to users. Now, the accounting equation, assets. Let's think of some assets. It's companies' resources that will provide a future benefit. But can any of you guys just call out names, different types of assets, accounts that have assets? Receivables, cash, inventory, land, buildings, equipment, investments, intangible assets. Those are all assets that we're going to show on the balance sheet that are resources we own or control that provide a future benefit. They're going to benefit us more than the current accounting period. Liabilities or obligations that we have to pay back. They may be obligations to vendors to pay the bills. They may be liabilities or loans on the books that we have to pay back balances to the banks. They may be bonds where we received investment from bondholders where we owe the bondholders back their principal. We may owe interest on loans that we accrue until we pay them. And then we've got something called shareholders' equity. It's basically all the residual interest in a company. The shareholders' equity consists of the beginning balance that came in from the previous year. It consists of any contributions made by shareholders, capital brought into the business. It will subtract from that any dividends that we pay out to the shareholders. We'll add our net income into there. And there are some other items we can add to the retained earnings portion of the shareholders' equity. But we basically start with the beginning balance, create some adjustments by adding capital, adding income, subtracting dividends, and come up with an ending balance. So what are the components of shareholders' equity? We basically have the capital that was invested by the owners, usually in the form of common stock. Then we have what we call retained earnings. Now, retained earnings is a portion of the stockholders' equity account. The retained earnings is a summary of all the income that we've paid, and minus the dividends, that we've paid over the life of the company. Then we add the net income for the current year, we subtract our dividends for the current year, and we have an item that will add to our shareholders' equity, which is accumulated other comprehensive income. There may be other comprehensive income items that need to be recognized under this portion, under the shareholders' equity. Now, the reason we're not recognizing it in the income statement is we've not realized it yet. Normally, we don't record a transaction till we've realized the event. And with the FASB has come up with a couple items that they want us to put into the stockholders' equity section under the accumulated other comprehensive income. Yes?
Can you review the difference between recognize and realize?
To realize a transaction means the event has occurred. So, for example, when we provide a service, we don't realize that income until the service has been performed and we're complete. We don't realize the income when we're in the middle of making the product. We realize it when the service or the product has been transferred to the buyer. Make sense?
So recognize and realize are both part of accrual accounting in that
Correct.
as it happens, but
We don't
recognize like if it's
we don't report it. We don't recognize it or report it until an item's been realized.
okay.
So, for example, let's say that we ordered product, we ordered supplies. Until we receive those supplies with a bill, that's when we can realize that expense or that asset as a supply. And we don't put it on our books when we just order it. We put it on our books when we've received it. Make sense? So there are various components of income. Revenues. Now, basically what this says, and I personally don't care for this definition, it measures the inflows of assets, which means cash or accounts receivable, and the settlement of obligations, which are accounts payable because of product, from selling goods and providing services to customers. So revenues basically consist of the cash or the receivables we derive from selling services or products to customers, okay? They call it measure the inflow of assets. They're basically saying receiving cash or receivables. And we're not just saying cash because oftentimes it's a receivable. We won't get the cash yet, but we're going to record a receivable on the books once we can recognize that income. Expenses measure the outflow of assets, such as cash, using up cash, that it consumes, and the obligations a company incurs in the process of operating a business. So it may be paying the utility expense. It may be purchasing supplies that we have on credit because we haven't paid for them yet. So the obligations a company incurs for running the business. At this school, the revenues would be tuition or possibly grant monies. The outflows or the expenses would be the utilities, the depreciation on these buildings, the instructors, the classroom equipment. To provide, we need those expenses in order to provide a service to you, which ultimately we get revenues from. Make sense? Gains and losses do not have to do with operating the business, the income that comes in and the expenses that flow out. Gains and losses are basically from selling assets or possibly settling liabilities for more or less than their book value. An example of an asset being sold that would provide a gain or a loss is a building. If this building is sold to the U of M, and let's say this building has an adjusted basis, all the money in it, any improvements to it, less the depreciation that's been taken on it. Let's say we have, for simplistic purposes, $10 million in this building. The Augsburg does. And if the U of M is willing to buy it for $20 million, on the books, Augsburg would show a gain. That's not necessarily a revenue. The revenues come from tuition. The revenues come from grants. That's what we're doing to make a living. But selling an asset is still income, but we treat it as a gain or a loss. So know that there's a difference. Revenues and expenses are a result of operating. Gains and losses are a result of selling assets. Net income equals revenues minus expenses plus gains and minus losses. This is a complicated breakdown of the accounting equation. So the only reason it's really complicated, assets are assets, liabilities are liabilities. But we take this shareholders' equity section and we break down the various components of the shareholders' equity section. We show the contributed capital, the stock that was issued, that we received money for, but the stock that's been issued, plus the retained earnings section is a result of whatever the beginning balance is, plus any net income from the period minus any dividends. And then we break it down further to show what is net income. Well, net income are revenues minus expenses plus gains minus losses. They flow into the shareholders' equity section. And then we have this other section, AOCI, and basically the AOCI is a cumulative effect. It's going to come from the beginning balance we start the period with, plus any other comprehensive income we have to include into it. So this basically, in a nutshell, is still the accounting equation. All we've done is really broken down the components of the shareholders' equity, that is the capital contributed plus our retained earnings plus the AOCI. So how business activities impact the accounting equation? Every single business activity will change the financial condition or the financial